Hello, this is Jordan, and this is your precious metals video market update. This is being recorded on the evening of Tuesday, October 18th, 2016. Thank you for tuning in, and today we're going to look at quickly gold and the gold stocks, and the sector looks like it has formed a short-term low. And let's start off. You guys, if you follow my work, you know that I produce analog charts. And this is a new one I whipped up last week, just looking at the corrections in bull markets for gold stocks. And we've had a recent correction. Gold stocks have declined about 30%. No matter what index you've looked at, it's roughly 30%. And we had a really strong move up. And there is some similarity to 2001 and 2002. But we went back and we looked at the strong 2000, 2011 period. And so we wanted to compare those corrections to now. And so you can see that we're plotting on the same scale the 2001 correction, the 2002 correction, the 2006 correction, and the most recent correction. And one thing we notice about all these corrections, it's very clear that they had three clear legs, like an obvious down, up, down. And the three legs were not nearly an equal size, but you can see the chart. I mean, it kind of looks like a big W. The 2002 correction lasted in terms of time a total of 10 months, and it had an extra two legs to it. And that was because the gold stocks into that 2002 top, they were far more extended and overbought than they were at the other periods. Now, from the 2000 low, they went up for 6 months, and then they just had a 20% sideways correction for 5 months, which we show here um, in this analog. And that correction gave way to a super strong move uh, into 2002, and the I don't have the Huey in front of me, but I think it was up 300 or 400%. It was just really overbought, so that's why that correction lasted 10 months and not only 5 or 6 months like the others. And where we are right now, I think that the move we had in the gold stocks, it's most similar to both 2001 and 2002. Now, looking at my overbought charts, um, the gold stocks were the second most overbought they've been in the past 20 years, if I remember correctly. The second most overbought to that 2002 point when they were the most overbought. And that's looking at short, medium, and long term type, well, not long term, but short term, medium term, intermediate term type indicators. And so, based on that, we knew that this would be a significant correction and probably worse than 2001. Uh, but we have to remember that the gold stocks only went up for 6 or 7 months. They emerged from a really, really bad bear market. So that was very similar to 2001. And so the gold stocks have already corrected 30%. That's far more than 2001. I think that in terms of time, uh, this correction could be similar to 2001 in that it corrects 5 or 6 months in terms of time, and it doesn't go a full 10 months like we saw in 2002. So that's kind of how I expect this thing to play out, and it looks like we've completed the first leg down. Blue is where we are right now, and after today, it looks like the rally's on track. And but the thing to keep in mind, we probably will rally, but those three other corrections, they all had a clear second leg down. They didn't go to a new low in terms of price, but they had a clear second leg down. So that's something that that we could expect to see uh, December, January, perhaps. Now let's look at the price action, the daily candle charts of GDX and GDXJ. And starting with GDX, we can see that it successfully, I think, two or three times, well, just twice, as far as days, it bounced off of its 400-day exponential moving average. Again, that's the exponential moving average, not the simple, which I normally use. And if you've seen some of my old videos, I noted that in bull market years, the gold stocks have had their corrections during those bull market years. They've tended to bottom at the 400-day exponential moving average, and it looks like we've seen that happen again last week. And so GDX, it appears to have bottomed around 22. Today it closed at 24.20. Had a nice move up. It was up almost 5%. Similar action in GDXJ. That's been stronger than GDX. The juniors corrected the same amount as GDX. I mean, given that they're more volatile, you would expect them to correct a lot more. So the juniors are showing more relative strength. The GDXJ did not come all the way down to that 35, 36 area. Instead, it bottomed, I think, at 37. Now, as far as resistance, I mean, you go back to the last chart, and this rally could go. I don't want to say it's going to go all the way back to the high because we don't know, but I'm just looking at where the initial resistance might be. And looking at GDX, the initial resistance is going to be around 26, but maybe this rally could carry up to 28. Now, with respect to GDXJ, the first strong resistance is going to be 43, it looks like, and then 46. Now, if you look at the weekly charts, the real stiff resistance, not showing the weekly charts, but the real stiff resistance can easily be seen at around 26 for GDX and 43 for GDXJ. But again, if you look at the analog, it's possible that the miners on this particular rebound could rebound a little bit farther than that. So the higher targets would be GDX 28, GDXJ 46. Finally, let's take a look at gold. And when we're in this correction mode, I mean, I focus more on the miners because they're going to lead the metal. I mean, just go back a month or two, and the miners were already showing weakness. They were already starting to break a little bit before gold, and then gold ultimately followed. Now, in this daily candle chart of gold, which is there in the middle and its volume is at the bottom, we also have the amount of gold in the GLD, which I plot at the top, and that's my own data I've uploaded into the chart. And the reason why I like tracking this is because the amount of gold in the GLD, that is a real-time proxy for investment demand. Investment, I mean, for demand right at the moment, like what's happening right now, what's happening yesterday, today, tomorrow, etc. And so tracking the gold in the GLD, the inflows and outflows, is very important for keeping your eye on investment demand. And look, we've talked about it before. The real fundamental driver for gold is real interest rates, and negative real interest rates or declining real interest rates. And fundamentally, what happens is big Western-based money, hedge funds, etc., Soros, Druckenmiller, these types, their demand shows up in the GLD. I mean, it's not Joe Blow going down to the coin shop and or the Chinese are buying lots of gold coins. I mean, that doesn't really drive the market based on all the research I've done. I mean, it's true China and India, they kind of support the market. They buy when it goes down, etc. But the real driver is investment demand and big Western-based money buying and investing in gold, and they do that for the most part through GLD, and that's why we should track the inflows and outflows of GLD. And I know it was a long description, but what we've seen in the last about month or so is that the amount of gold in the GLD, it looks like it bottomed in early September, and it's been slowly trending up. Even on I think it was Monday, we had 2 more tons of inflows. There were inflows the past 2 weeks. Not a lot of inflows, but positive inflows. And that is a good sign because gold had during gold's decline, its sharp decline from the mid 1300s down to 1250, which we've seen in the last week or two. There really wasn't outflows in the GLD. So this was a technically based sell-off. I mean, it was a legitimate sell-off, but it wasn't really there wasn't really a loss of demand. I mean, there weren't big outflows in the GLD, and it's interesting because this is very comparable. Now, you can't see it on this chart, but this is what happened if you go back to the 2006 to 2010 period. Gold did have some big, 20, 23% corrections there, 30% in 2008. But during gold's bigger corrections, demand, I mean, you saw a few outflows, you saw a little bit of a reduction in demand, but you never saw anything that big. And so we're seeing that again right now. And that's a good sign because that is totally different from what happened during the bear market, and especially in 2013, 2014, 2015. I mean, anytime gold was going down, I mean, just everything was coming out of the GLD. There were huge outflows. So we're not seeing that happening. We're seeing what you should see in a bull market, which is even though gold's correcting, demand is stabilizing. And like I said, on the weakness in recent weeks, we've seen inflows into the GLD. Now, that was a long amount of analysis there on GLD. But getting back to the price action of gold, it looks like it's holding 1250. There's a confluence of support at 1250. It's a 38% retracement of the entire move up. Look for a rally up to 1280 to 1300. There's a lot of resistance there. Maybe this will go all the way up to the 1290s and get close to 1300. We can see towards the end of the year that there is a confluence of resistance around 1300. We'll keep that in mind later. Some other support targets to look at just in case gold might test lower levels after this rally. I'm not predicting it's going to do that, but it's just something to keep in mind. The two strong areas of support are number one in the low 1230s, about 1230. That's the 40-month moving average for gold. Look at a monthly gold chart going back 50 years. The 40-month moving average is extremely important. And then my favorite moving average, the 20-month moving average, also equivalent to the 400-day, which you can see on this chart. That's at about 1203. It's rising slowly, and you can connect a line from the February low, the March low, the May low. You connect a line there that kind of comes in around 1220 or even 1215. I mean, laterally, it's about 1210 to 1215. So that is another target to keep in mind. Again, I'm not predicting gold's going to go lower and test those levels, but just keep those targets in mind of 1230 and down around 1215. So again, that's all I have for today. Again, I'm focusing more on the miners because they lead the metals, and it looks like we have a short-term low in place in the sector, and the miners should rally for a little while here. But according to history and according to that analog chart, I'm looking for another buying opportunity coming up, perhaps in maybe at the end of December or sometime in January. We'll see. Anyway, you can follow all of my work at thedailygold.com. Go there, opt in for my free newsletter where you'll get my free weekly update every Sunday morning, and in that update you'll get my most recent thoughts on the sector. You'll also get some things I'm reading from other analysts. I link to other articles or videos or posts or interviews that I find informative, and also you'll get some snippets and comments from my premium update, which I send on Saturday. Again, thank you so much for joining me today, listening and watching this video, and I look forward to publishing another video update for you in the days and weeks to come. Thanks.